This is Real Estate This Week with Stephen Gasque, continuing 16 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasque, and Happy New Year. I'm so glad you're here as we look at the 50-year mortgage, a new proposal designed to help more people buy a home of their own. Under the plan, monthly mortgage payments would be lower, but the mortgage would last much longer, 20 years longer than the 30-year mortgage, and it will cost more interest. Today, we'll look at the facts and let you decide what you think about the 50-year mortgage. Joining us now is Keith Gumbinger, Vice President at HSH.com, the nation's leading source for consumer mortgage and finance information. Keith, welcome to Real Estate This Week.
It's good to be here, Stephen.
Keith, I am so glad you are here, and Happy New Year.
Happy New Year to you as well, Stephen. Here's to a great 2026.
Absolutely. Now, Keith, first of all, the concept of a 50-year mortgage is really quite simple. Instead of paying off the mortgage in 30 years, you pay it off in 50 years, which would reduce the monthly payments. But now, is that it? Is that the only difference between the traditional 30-year mortgage and the proposed 50-year?
Well, it's that simple in concept, Stephen. I mean, the idea of a longer-term mortgage to promote homeownership isn't new. I mean, originally, FHA mortgages were 20-year terms, later extended to 30, and we saw 40-year and 50-year offerings back in the mid-aughts housing boom. I mean, longer-term mortgages didn't gain a whole lot of traction at that time, though.
Interesting. Now, why do you suppose that is?
Well, there are some drawbacks to these, and we're going to get into them as we talk about this concept a little bit. But, the drawbacks are that the savings are only so-so, and the costs can be extremely high.
I see. And yes, in talking to you the other day, you told me that the 50-year mortgage is not brand new, that people did suggest it back about 20 years ago.
Before the last housing boom and bust, we did see all kinds of exotic products, including 50-year terms, some proposals for as long as 100-year terms, if you can believe that. That's just paying for your mortgage from birth to death, and no one really wants to ever consider doing that. So.
I had never heard of 100-year mortgage.
There were proposals for them.
But Keith, we do have a 50-year in front of us. It is a proposal. So let's take a look, beginning with how much a home buyer would save on monthly payments. Now, if someone were to buy a home that cost $300,000, can you run the numbers for us about what their monthly mortgage payments would be under a 50-year mortgage compared to a 30?
Well, if we assume the loan amount you're going to be taking out is $300,000. We have to say when these were last offered, the interest rates for 50-year terms were slightly higher than those found on 30-year terms, about 1/4 percentage point or so. Now, with that in mind, the difference in monthly payment between a 30-year fixed rate at 6.25% and a 50-year term at 6.5% for a $300,000 loan is about $256 a month.
$256 a month. Now, Keith, that is a savings. And, even though it doesn't sound like an enormous savings, that could be very helpful to someone who is buying a home for the first time and someone who can barely get into a house. But with those savings, it just might be possible. What do you think?
Well, I mean, that's definitely true. The longer term does help stretch borrowing capability to a degree and might be enough to see a borrower get an opportunity that they otherwise might not have had. Now, working numbers from the National Association of Realtors quarterly existing home price data for the third quarter, my calculations show that for a borrower to buy the median priced home at $426,800 with a 20% down payment and factoring for insurance and taxes, that they need an income of $112,000 a year using a mortgage with a 30-year term, but $105,000 using a 50-year term. Now, that can be very helpful. I mean, it's not exactly a game changer, but definitely enough to get some of those more marginal, kind of close, almost make it borrowers into the game.
I see. So there are some upsides to this. Now, you mentioned mortgage interest rates before. Is it expected that if we do see a 50-year mortgage, the interest rates will be higher, lower, or the same as a 30?
Well, the odds favor that since you're asking an investor to take on potentially an additional 20 years worth of risk, that the interest rates are going to be somewhat higher. Now, we don't know how well they'll be accepted in the marketplace at this point, whether there only would be government-backed loans and rather than being a kind of private market offerings. So it's hard to say, but for a good working, purpose, we'd go with about a quarter percentage point higher than a traditional 30-year fixed.
I see. And Keith, now let's look at something that's obvious to people who have owned homes before, but might not be so obvious for people who have not owned a home. And that is, the mortgage payment is not the only monthly bill. They'll also have to pay homeowners insurance and property taxes. And obviously, the 50-year mortgage will not have any impact on those at all, correct?
That's true. The mortgage term and the interest rate on the loan only affect the principal and interest cost. Insurance, taxes, homeowner fees, maintenance costs, those are not affected at all.
I see. And as we know, insurance premiums and property taxes tend to go up over time, so a prospective buyer should be aware of that as well.
Of course.
So Keith, now let's look at the long-term expenses of a 50-year mortgage. Looking at that same house we talked about before, where the mortgage amount is $300,000, if someone took out a 50-year mortgage, how much more interest would I pay in those 50 years than I would in a 30-year mortgage?
Well, this is where the drawback to an extra long-term mortgage is revealed. In our $300,000 example above, total interest you would pay for a 30-year term would be $364,796. For a 50-year term, $714,692. And that additional $350,000 in interest cost nearly doubles the cost of the mortgage.
Now, wait a minute, Keith. We're not talking about any principal, any equity in the home at all here. We're talking about just what you pay the lender in mortgage interest. And for a 30-year,
That's correct.
It's in the 300s. In a 50-year, it would be in the 700s, $700,000 plus. That's huge.
It's part of the reason why folks didn't jump on these when they were first available. That long-term interest cost is really a daunting mountain to look at for a long period in your life.
Oh my gosh. And Keith, another factor that homeowners all dream about is building equity in their home. And it would seem to be just very simple math to observe. It would take much longer to achieve, say, 20 or 30% equity in a house using a 50-year mortgage than it would using a 30.
Well, as you would expect, it will take a lot longer to build equity, at least from paying down the mortgage. Now, if a borrower bought a $333,000 house with a 30-year fixed at 6.25% with a 10% down payment, that is a 90% loan-to-value ratio, the loan amount would be $300,000, as we mentioned above. Now, to get that 90% LTV ratio down to 80 LTV solely from making payments would take about 92 of them, just under 8 years to get to that point. Now, for a 50-year term with a 6.5% rate, it would take 244 payments, more than 2.5 times as long.
Keith, that is huge. That is great information. And of course, we should also observe that you build equity two different ways when you own a house. One, as we just mentioned, is paying down your mortgage, which would take much longer with a 50-year mortgage. But another way that you increase equity is price appreciation over time. And I think it's fair to say that if you bought that $300,000 house today, well, in 50 years, that place would probably be worth a few million.
Well, that's likely true, or at least we hope it'll come true, Stephen. I mean, But you do have to think about it, not to be morbid, but with the median age of the first-time home buyer recently reaching 40 years, a buyer with a 50-year mortgage term might not be around to see those appreciated gains.
The dark side of real estate. And another question, Keith, about PMI, private mortgage insurance. In most cases, that adds a couple $100s to a monthly mortgage payment until the homeowner reaches 20% equity. So with a 50-year home loan, they'd be paying private mortgage insurance much longer, right?
Well, that's definitely true. I mean, you would be much more at the whims of the market and price appreciation to get you to a PMI cancellation point. Now, we also don't know if there will be private PMI policies available. I mean, those are private mortgage insurance for 50-year terms. Those insurers may or may not wish to take on that additional risk. And if they do, we don't currently know what policy costs will be. So it's hard to reckon how much more it would cost you for PMI for a 50-year term than a 30-year at this point.
Interesting. And Keith, here's probably the toughest question of all. We've all heard over the years about the benefits of homeownership. Now, if a home buyer used a 50-year mortgage to buy a house, would all those benefits like appreciating property values, the ability to deduct property taxes and mortgage interest, and much more, would all that be worth it, considering they'd be paying much more interest over the decades and they would build equity at a much slower pace than if they used a 30?
Well, while homeownership certainly has its benefits, it also has costs, and we can know the cost of using one of these longer-term mortgages. It's simple math, as you mentioned, but we can't be certain of the benefits of owning a home. We can't assume that home values will inexorably rise or rise at a fast enough pace to offset much higher interest costs of that extra long term. As the loan balance is being retired so slowly, it increases the chances that a homeowner could incur a loss when it comes time to sell after all the costs are considered, especially if that happens in the early years of homeownership.
I see.
So someone contemplating using a 50-year mortgage should do so with an exit strategy in mind, or at least a working plan to refinance, perhaps multiple times, to shorten that mortgage term as quickly as opportunity permits, even if it means there's no improvement in monthly payment or even at a slightly higher interest rate.
Keith, that is great advice. And now a question about the future. As we know, right now, the most popular mortgage in America is the 30-year fixed-rate conventional home loan. Now, if the 50-year mortgage becomes reality, do you think it will become popular too? Or will it just sit there as an option that virtually no one takes?
Well, I think like adjustable rate mortgages, there'll be a certain percentage of the marketplace that would be attracted to a longer term 50-year mortgage. Those monthly payments are a little bit lower, get you in the door a little bit easier. But there are some things to consider if these do come to fruition and get into the marketplace, and not the least of which is refinancing opportunities in the future might not be as pronounced as you think. I mean, if we have only 30-year terms and 50-year terms and nothing in between them, someone who wants to refinance a few years from now will have to shorten that term up by, say, 10 or even 15 years, going to a 30-year mortgage from a 50. And that could mean higher interest rates, higher monthly payments. It's going to be very difficult once you're in one of these 50s to get out of one of these 50s, I suspect, because I don't see the market developing around it for intermediary term products between 30s and 50s. But again, we don't have 50s on the market yet. Still just a proposal. But if they come, we'll have to see how the market responds to prepare borrowers to manage these over the long haul.
Well, Keith, I really want to thank you for being on the show today and telling us about the facts behind the proposed 50-year mortgage. And I think everything you've said is so valuable for everyone hoping to buy a home. Thank you, Keith.
My pleasure, Stephen.
Ours too. Keith Gumbinger, Vice President at HSH.com, the nation's leading source for consumer mortgage and finance information. Next time on Real Estate This Week, buying a house in a brand new year. we'll bring you expert advice on how to make it happen so that 2026 is the year you buy your very own home. That's next on Real Estate This Week. And until then, I'm Stephen Gasque, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasque drops every Thursday, everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasque. The best real estate strategies out there, just for you.